Hello everyone and welcome to the Cyclical Investors Club YouTube channel. This week I'm going to compare two different stocks to each other, Disney and Comcast. And I really haven't found another comparison like this in the market. There's some really expensive stocks, but there aren't usually comparable alternatives to them that are basically value stocks or growth at reasonable price stocks. Usually, if you have like a Tesla or whatever, you don't have a comparable value stock to go along with it. That's not the case with Disney. It's really, really richly valued right now. And Comcast has a similar business, but I would argue a better one right now that actually earns shareholders more money. And they should benefit from the reopening economy the same way that Disney will. But the market is valuing it at like half the valuation of Disney. I've done actually a lot of historical research on Disney. I haven't written or talked a lot about it, but I am pretty familiar with the business. That isn't always the case when I analyze a stock, but it's such a popular stock that I did a little extra research. So I have some books to recommend for people if they want to learn a little bit more about Disney, the business. And I've read all these. They're a little thick, most of them. So this is just a biography of Walt Disney, and it's called The Triumph of American Imagination by Neil Gabler. Okay, that's what it looks like. I read this one last year about this time, and what I found really interesting about it is just how risky Disney's business was in the early stages. Walt Disney was really kind of like an Elon Musk type person. I mean, there was a lot of ways that Disney could have failed. You look at all the different types of competition that they had and how many of them failed. I mean, most of them did. I think Warner Brothers, is still around, but most of Disney's competition just didn't make it. From, if you go back to like the 1920s and 30s, they went through World War II. And then all sorts of things after that. The original Disney park was a huge risk. So you really understand and gain an appreciation for the creativity and the risks that Disney took on. Now, it wouldn't have been the type of company I probably would have invested in until the 1960s or 70s. But it was really interesting to read. Now, moving into the 1980s probably would have been the time where I think that's probably been where Disney had the best valuation, and you started to see it with some private equity interest in them. They basically didn't have any debt. They had a lot of ways that they hadn't fully monetized or capitalized on their parks and their brands and everything. And then when Eisner came in, he took advantage of a lot of that, I think, the first 10 years or so. And they got lucky with the transition to VCR tapes. So they had a lot of merchandising that came out around that time that they really just hadn't profited from before. And so they sort of got lucky on these technological changes and different ways they were able to distribute their movies to people. This book, again, another thick one. I've read the whole thing. Disney Wars is really a pretty great read for that time period, I think. And it's nice to get kind of an outside view of what was going on at Disney. It's really kind of the story of Eisner's time there. You have kind of the first 10 years where things went pretty well, and then really challenging years after that with a lot of internal conflict within Disney. And it gives you a pretty good perspective on what was going on and the challenges that were there. So I think the main takeaway of these, well, there's a lot of different takeaways, but in terms of the business, what I realized was the parks business is really their most stable earnings generating business, okay? The media business, which is what everybody, we care about the parks, Disney World and Disneyland and so forth, but the media business is really, it fluctuates a lot more. It takes a lot of money to make. We always hear about how much money a movie earns at the box office, but usually people don't talk about how much money it actually takes to make these movies. So the profitability of the movie brands has really been a roller coaster ride, and it's not very dependable, but most retail investors don't understand that. You really saw it when they first came out with the first Star Wars movie. I've only written one article on Disney. It was in 2015. Disney stock had kind of done the thing that it is doing now, where it just really got ahead of kind of rational earnings on the back of this anticipation of Star Wars movies coming out. And I suggested people should, instead of buying Disney, they should buy a movie theater. I think it was Regal Entertainment at the time, for just a medium-term play. And it ended up working really well. Disney stock fell like 20%. Regal went up like 40% because people went to the movie theater to watch the new Star Wars stuff. So, but I haven't really talked about Disney since then, mostly because retail investors don't really understand that these movies don't bring in dependable earnings for the company. But what they do often do, or usually do, if things work out well, is they push business into the theme parks. And that's where the real money is made. And then occasionally you get lucky and there's like some bonus merchandising that comes along. When you have something like a Frozen or something, you get that boost in extra merchandise that comes along. So I view the parks as the core business, the media and the creativity as the driver of that business, okay? Now, the problem that Disney ran into in 2000-ish or so, the late 90s, early 2000s, is that basically they weren't creative. I mean, for whatever reason, the creativity was lacking, okay? And if you just look at Disney's best movies, they were all Pixar movies at that time. So what happened is when Bob Iger came in, he made some good moves, I think, but I think investors, especially retail investors, they misinterpret these because it was really a move of desperation. The reason Disney had to buy Pixar, the reason they had to buy Lucasfilm, the reason they had to buy Marvel, or the properties of Marvel that they could get their hands on, was that they couldn't create themselves. Their creativity was basically not there. So they had to go buy these creative products that other people had created. Now, that cost Disney because they had to issue shares, borrow money, basically use earnings to come up with the money to buy these properties, okay? So then they had to earn that investment back. You really noticed it. You didn't notice it so much with Pixar because Pixar had all these movies in the pipeline, and they had a pretty good runway of kind of creativity, and Steve Jobs had just had things really kind of rocking there, creativity-wise. But I really noticed it with the Star Wars franchise, okay? In order to justify the price that was paid for Star Wars, if I can get my autofocus to work here, Disney had to churn out these movies really quickly, and they really couldn't afford to have like a dud, right? They couldn't afford to take chances at all, and you really saw it in like the story writing. I mean, they're basically just like rehashed stories that have already been told, reboots. I mean, with a couple little twists. I mean, there was nothing new going on there, and then they were churning them out just as fast as they possibly could. That was so they could pay back the investment that they had made in the franchise as quickly as possible, okay? So they managed to do that, but I think that they damaged the brand a little bit along the way with kind of the, we'll just call them not great movies, not great Star Wars movies, and they're starting to redeem themselves a little bit with the Mandalorian franchise, okay? But the hard part for them is going to be that there's not a creative, they still aren't creating things themselves. They're just hiring people to come in and build on these franchises, and I think the results are going to be really spotty. I mean, when you get a creator like the guys at Mandalorian, Disney kind of is getting lucky getting them. I mean, the next time around, it might not work that way. And the more you try to scale that, the more difficult it becomes. I mean, there's good writers in Hollywood, but eventually people are going to get bored with it. It's not going to have the same impact, you know, that Star Wars had in the late 70s and early 80s. And the same really kind of goes with Marvel. There's only going to be so much rehashing people can do until they just become kind of so-so hit and miss franchises, which is okay if they can eventually drive that into new theme parks, in my opinion. So it's really, the theme parks are really where the money is. I also, another Disney book for you, Bob Iger's. I'm not sure what to call this. It's The Ride of a Lifetime is the name of it. I read that one too. It's disguised, I would say, as a leadership book, but it's really like an apology, not like a I'm sorry apology, but like a classic apology, a defense of his CEO decisions, I guess is how I would. And there are some weird sections like about Hillary Duff's mom, and I mean, but really it's just him kind of disguising and explaining his point of view on some of the decisions that he made as CEO. Read the right way, I think it's insightful. Read the standard way, it's probably kind of a fluff book, basically. But it does give you some perspective into what was going on inside his head when he was making the purchases he had. Now, taking all that into perspective, we basically have two things going on here. Disney's all in on the streaming thing, and because they're trying to duplicate basically what Netflix has done, but again, they're operating from a position of weakness because Netflix really got the jump on them in some degree, and it's weird to see Disney do this kind of 180 where they want to do their own thing streaming wise, when they can just sell the rights to their stuff or lease them out to Netflix or whatever and make money and do nothing on them. So, and then they could take money from the highest bidder. So I understand that Disney Plus has a lot of subs. They can eventually raise the prices. I think over the very long term, they'll probably do just fine because they have good properties. They can create good enough content. But they're not on par with Netflix content. And it's going to be hard for them, I think, to compete price-wise with Netflix going forward because they just don't have the same creativity that Netflix does. The other thing is, I think the Pixar, the Marvel, and the Lucasfilm purchases from Disney made sense, the Fox purchases a couple years ago, like Iger's Last kind of thing, I really think Disney way overpaid for those. I mean, way overpaid. They didn't even need them. Nobody goes to Disney Plus, okay, for the Fox assets, right? I mean, maybe ESPN and Fox Sport, maybe they got something there, but even if they got something, it's like they just paid way too much for it. So I think that was definitely a mistake. We're not really gonna, a lot of the negative aspects of that are not gonna show up because COVID, everything can be blamed on COVID now. But what you'll see it in the recovery. Disney's recovery from COVID will be slower because they overpaid for this Fox stuff. I mean, I don't think anybody's getting Disney Plus to watch Simpsons episodes from like 20 years ago or whatever. So they're getting it for The Mandalorian, right? And so there's a lot of things, along with the cord cutting and the cable subscriptions pulling back, that were hurting Disney even before COVID came along. And I'm going to show that in the numbers when we get into the graph, okay? So we have kind of Disney there doing the things that they have to do. They're being forced to do them, okay, in order to survive. These aren't things that are Disney's being kind of out in front of anybody on. I mean, they are just chasing everybody, trying to stay relevant, and COVID just made it worse because the parks have been closed. That's how I think about Disney. In the meantime, the market has driven the price up. They did exactly the opposite of what it probably should have done. Now, if we look at Comcast, that seems a lot more rational to me. You know, they have theme parks too. They make movies. They have, networks, but they also have their cable business, which during COVID, while there has been cord cutting and things, just the same way that it affected Disney, a lot of people upgraded to like higher speed internet. What Comcast doesn't have is like a brand than Disney that attracts retail investors, right? Nobody likes their cable provider. I mean, I've never had one. I have a new one actually that I actually do really like. It's a fiber company, but my previous ones, I always hated them. So because they're always overcharging you. Eventually, I just got rid of cable. I haven't had cable since 2009, so I was an early cord cutter. But basically, Comcast, his stock has been treated pretty rationally by the market, whereas Disney's has just gotten way overpriced. But I think this reopening, Comcast will be opening up its parks more. Theaters will be opening up more. People are going to have more money because there's been a lot more stimulus from the government. They're not going to rush right out and cancel their cable subscriptions, I don't think, because a lot of people have a bunch of money sitting in savings, so they don't really have an alternative. It's when times get tight, you're like, where can I cut? And that's when you go to cut your cable, to cut your cord. So it just seems much more reasonably valued compared to Disney, especially, and then compared just to the S&P 500. So it's not at a super value. I mean, I bought the stock almost 30% lower about a year ago, but it's very reasonably valued, and compared to sitting in cash, compared to most of the other alternatives in the market, I think it's a good buy. So I'm gonna have a little break here, a little disclaimer, and then I'll get into, showing you the numbers, showing you the graphs, showing everything else about the two stocks. All right, thanks for watching, and we'll get into the rest of this here in just a second. Hello, everyone, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer, and this is a channel where I share my investing process and strategies using examples of stocks that comprise the S&P 500 index. These videos are for educational purposes only and are not personal investing advice. If you would like to receive analysis on stocks that are not part of the S&P 500 index, as well as receive additional in-depth portfolio strategies, consider joining the Cyclical Investors Club premium service. It has produced market-beating ideas and strategies, costs less than $30 per month, and it helps support the investor education and research that I share with the public. With that, let's get into it. Okay, everyone, before we get into the commentary that I have about Disney versus Comcast, let's just take a look at the historical numbers and see what the numbers are telling us, and then we'll get a little bit more into talking about kind of the story and what goes on in the business a little bit more. So here's a chart of Disney along with their earnings. This dark green area shows their earnings per share over the years. Over about 20 years. So what I want everybody to focus on here is, obviously we know Disney's business has been hit hard because of COVID, and a lot of their parks have been closed, movie theaters have been closed, and so on. Their streaming business has been getting a lot of subscribers, but that actually doesn't make any money yet. So we can see their earnings have fallen dramatically, okay? This is for 2020 through September, and they're expected to stay the same for 2021. So we have 2 years here of poor earnings, and then we expect that as COVID gets taken care of and so forth, the economy opens up, parks will open back up, movie theaters will open back up, and things will get better, and that's what analysts expect. So they expect earnings to come back in 2022 and 2023. So that basically by 2023, they're where they were in 2019, right here. Pretty close, maybe a little bit more. So that's kind of what's going on. Now, if you look at the price, it's completely disconnected from all that, okay? So earnings are going down and the business is suffering while the price is going up. And that's all in anticipation of their streaming service doing well and just basically being priced differently. We know they have the subscribers. People are probably treating it kind of like Netflix, and they have a popular name, and it's just pulling in a lot of retail investors, I think. But what I want to point out here is that, let's shorten this graph up to 2015 and look at the last 5 years leading up to where we are now. what I want to point out is that, one, they don't have very much growth in earnings here, even before COVID. And actually, earnings were falling before we even had COVID. So they weren't doing very well in terms of earnings growth, even before COVID came along. And that's because people are shifting away from cable subscriptions, which they make a lot of money on ESPN via cable subscriptions. And so they were able to charge people basically an exorbitant amount of money for these services from ABC and ESPN. And people moved away from that into streaming, or started to, and so they started to suffer because of that. And basically, we have almost 3 years before they're even expected to get back to 2019 levels. But if you look at the stock price, it's actually at a new time high. So total disconnect basically from the fundamentals, even looking forward like 3 years. So we don't really have a lot of value probably being created here, at least in the next few years. Now let's compare that to Comcast. So we look at Comcast. Basically, their earnings go in a straight line upward until recently. Now these guys have lots of different properties. They have theme parks just like Disney does. They have networks, but they also have their cable business, which has really helped them through this pandemic because a lot of people signed up for like high-speed internet because they needed to work from home. So that helped offset some of these, some of the COVID-related damage that was done. And you can see their earnings fell in 2020 about 17%. Okay, but they're expected to come back a little bit this year, and then really expected to do well the next couple of years, like 20% growth or something if you average these two together. So if we look forward like 2 years for Comcast, they're doing way better. And if you look at the stock price, it's near a high as well, but not nearly as disconnected. I mean, it's trading at a 20 PE. That's on probably blended earnings of right in here. And it's expected to probably grow over the next 3 years, like, I don't know, close to 15 to 20% per year if you averaged it. So the value you're getting here is a lot better, and they'll also benefit from reopening because they have theme parks and movies and things like that too. They also have streaming service that they launched. Now it's not as popular as Disney Plus, but they haven't dumped as much money into it, and they're monetizing it at least as well. So they have a different strategy that actually involves making money for shareholders, which is what we care about. So that's kind of the big picture view here. Just, you know, you have Disney, which is trading at an exorbitant PE, even based on this, which is what we'll look at in a second, compared to Comcast, which is very reasonable. So let's take a look at the spreadsheet here. All right, and I wanted to compare these two together because they're reasonably comparable if you're kind of aiming for the same thing. They're both kind of media companies, but with Comcast, you have the cable subscription service that kind of funds everything, whereas with Disney, they don't really have that. Their parks traditionally have been where they make all their money, so, or at least their most stable money. So they make the films that generates the kind of interest in their product, and then when they really make money is when people go to the theme parks. So they've been extra damaged by COVID here. But let's look at the numbers. I'm going to be extra generous with the kind of time frames that I'm using here. So if you look at their average PEs between Comcast and Disney, they're almost the same over the last 2014 to 2015. With Disney's, I only ran it to 2019 because of that big dip in earnings that we had because of COVID. So this is what they averaged leading up into COVID. Now the current PE ratio for Disney is about 30, which is double what Comcast is. And this is based on using earnings all the way from 2023. So I'm assuming that all this good stuff happens here, that they recover back higher than 2019's earnings, okay? And even when you do that, so you can see here it shows Disney at a 90 PE. So I'm showing them at a 30. If you use those forward earnings, like double year forward earnings, be it as generous basically as I possibly can, it's still very expensive. It's double what Comcast is. So that's what you're paying for earnings wise. Now, if you look at their growth rate, here's my cyclically adjusted growth rate for them. So this is from 2014 to 2019, okay? Before COVID came along, they were only growing earnings at 6%. If you take into account the shares they were buying back, okay, they bought back about 15% of their shares there. And so that's okay growth, but it's not enough to justify a 30 PE. With Comcast, on the other hand, I actually included the estimates all the way through 2022. So when I do I used this earnings number, much like I did with Disney. I went ahead and assumed we would have a recovery. Okay, so they're kind of on equal playing field there. But unlike with Disney, I actually included this downturn calculation into my earnings growth for Comcast. So this is actually quite a bit more conservative in terms of what I'm expecting. As you can see, I mean, even going here, let's go to Comcast. Even if we go here, their analysts are looking at 16% growth, and I'm just saying over like the next decade, we're probably closer to 9 or 10 in my estimates, 9.6. So again, very conservative growth rate for Comcast. And probably a generous one for Disney because I don't include any of the downturn that didn't already happen in 2019. All right. So using a conservative growth rate here and a reasonably aggressive growth rate based on history anyway, here, we can get a business return for Walt Disney of just under 4%, whereas with Comcast, it's 8%. So this is a CAGR over 10 years. And what this is basically if you invested $100 and bought Disney's whole company and you just collected all the earnings for yourself for 10 years, you could turn that $100 into $146, and that CAGR, and that's how I calculate the CAGR here. Okay, so with Comcast, you would earn $217 on that same $100. So you earn a lot more money, and I would point out these are pretty generous because again, I'm using earnings, totally recovered earnings 2 years out. So that would really be, I'm pulling all that forward. So it's really like a 12-year, you're looking at 12 or 13 years. And this is all you're going to get from the business. Now, I suspect that over time, there's going to be a mean reversion to this 18 or so PE that will happen once earnings that people expect don't materialize as quickly as they expect. So if that happens and the PE reverts from its 30 down to the 18 that it normally trades at, you're going to lose about 5% per year with Disney stock. Conversely, if Comcast PE adjusts to its average PE, you're going to gain a couple percent per year. So when you put that all together, I mean, the difference is so stark that there's not even really a contest here. So Disney, you're probably going to lose about 1% a year. You're going to earn a little bit from the business as it comes back, but the mean reversion that's likely to happen here over this time period is basically you're going to be about flat to earning no money. Whereas with Comcast, you're going to earn probably like 10% a year. So there's just not really a contest between the two of them in that regard. You can see it reflected in the PEG ratio as well. Now these earnings include some acquisition. And when a company buys somebody, their earning or their revenue generally goes up because they have more product, but that doesn't take into consideration what they actually paid for the company. So, but these are both positive, so they look okay. Recession PE, again, I mean, Disney could fall 60% easily. Comcast, more like 20% if we had a recession from these prices. Probably again, we see this is a little hard to see here without me showing it on a graph, but Disney's debt to equity, it's not super high, okay? But it's growing, okay? It's growing pretty fast. Whereas Comcast is a little bit higher, but the trend, even the past 2 years, has been down dramatically. So they're kind of even in these respects, but they're moving in completely opposite directions. Disney's debt's going up while Comcast is coming down. So that basically sums it up numbers-wise. I mean, there's just not really a contest. If you own Disney stock, you want to swap it for Comcast if you're a medium or a long-term investor.